right, time to talk about what we learned this week, a little bit about what's ahead. Our big picture panel on the Schwab team begins. Joe Mazzola, Director of Trader Education at Charles Schwab, joins us alongside Collin Martin to talk some bonds. Good afternoon, gentlemen. Joe, get us started here. I mean, tech definitely seems like it can carry the torch for us right now.
Oliver, if you were to tell me last night that Apple would be down on earnings, you'd get a 350,000 print on new jobs created, and you would had the 10-year, up 1.7 points. I would have said this market would have been down, multi-handles today, and I'm shocked. I'm baffled. It just shows the strength and the reach that the mega caps have. That blowout earnings from Amazon, blowout earnings from Meta can really just propel the market higher and higher. And I think it also shows to a certain extent, the risk concentration within those names that you start to see more and more people really start to kind of pack in their positions within those names to give it this boost.
Collin, when you described the data from this week, all of it, obviously the jobs kind of carrying the heaviest weight, but it was a pretty packed week of numbers. What's your takeaway?
Yeah, most of the data was actually a bit better than expected as if you look over the past 5 days. Even if we look at something like the ISM Manufacturing Index, which we got a few days ago, that's something that has been running below 50 for a number of months, and all of the subcomponents have generally been showing weakness. But then that actually surprised to the upside a little bit. That was kind of the precursor to what we got today.
Thank you.
But then today,
nobody's giving that report enough credit. Wasn't that a huge number?
The ISM?
Yeah.
I don't know if it was huge because we're still in contractionary territory, but it's getting closer to 50. I think next week's ISM services could be more important because services are much more of a driver of our economy than manufacturing is. But yes, ISM, that was an upside surprise and kind of changes the outlook a little bit.
Yeah. Okay. Glad you bring that up. Prices paid pretty warm in there. New orders popped a little bit too. I mean, that thing's been the big laggard. It's like everybody keeps thinking things are going to keep deteriorating, Joe, and it's like our worst economic sections are firming.
Yeah, no, I mean, it's hard. It's kind of hard to bet against that right now. And I think the markets have kind of shifted gears and kind of moved away moved away from some of the cyclical names that, we're betting on a decrease in the interest rates and kind of using that to propel them forward. And in November into December that we saw, when you saw the big move in the Russell, you saw the big move in, real estate sector, utilities, financials, so on and so forth. Financials have carried forward into this year, but for the most part, it's been a rotation back into tech, just because of the free cash flow, because of the kind of the sterling balance sheets, and because of the growth at a reasonable price. Now, reasonable is debatable. I mean, you still got the S&P trading at about 20 times forward price, but earnings have been pretty good. They've definitely stepped up, and I think that everybody was kind of sitting, waiting to see what was going to happen with the mega caps, and for the most part, I would say at least four out of the six have been pretty spectacular, and that's really helped drive the growth. If you look at 72% of the S&P 500 beating on the top on the bottom line, and about 66% beating on the top line. That's that's not knock it out of the park territory, but it's good enough to keep the rally going. It's
good enough. To your point, under the hood a little bit, because I know you watch this stuff while we're on that subject, Joe. The concentration still does leave some divergences underneath the surface.
Yeah, absolutely. So I'm just taking a look at some of the figures right now. We're starting to see a little bit of the breadth in the RSI, show that there are some of these bearish divergences. I think, you've seen the S&P move to 63 from 76 of the percentage of stocks above the 50-day moving average. And, the NASDAQ is down to 44 from 55. And you were mentioning the Russell earlier, it's down to 44 from 64. So, they're not all participating, and it does seem to be kind of building up in that concentration. But Oliver, you and I were talking about this over the last couple of weeks. Hedging got cheap. If you wanted to do it, you could do collars for basically nothing. Well, clearly nobody wanted to do it because they didn't have to. If you get a 20% move in Meta, and then you're going to clip yourself off at the legs if you do that 10% hedge. So I don't know.
Yeah, they're ripping
it
calls
just keeps
instead.
powering forward.
They're just putting more on top of
calls.
it. All right. So the thing here, I guess, is we go into next week with Fed commentary and then a couple more prints that are going to be really key until March. Collin, there was that moment this week before jobs when the bond market basically took Powell's March commentary and said to shove it and pushed, still the cut narrative. We were at like 50% almost before this jobs thing. So should we expect bond bulls to keep pushing back at like anything other than the most hawkish data or language?
I think they're going to have a hard time doing that given the recent data that we've seen. You kind of go into your point before about the totality of the data. And if we go back to Powell's comments, he kept getting questions about, well, what else is the Fed waiting for? Because if we look just at inflation, you can look at a number of different measures, specifically those 3 and 6 month annualized numbers that a lot of people are pointing out that we're at 2%. And Powell kept saying, well, we need time to make sure that what we're seeing now is expected to continue. And then over the past couple of days, back to that prices paid in the ISM report, back to the average hourly earnings in today's jobs report, that's likely to give Fed officials some pause. And if anything, that would push back their timing of potential rate cuts. So I think it'll be difficult right now for any specific economic release, at least in the next week or two, that would meaningfully pull up those expectations for a cut in March. I mean, we're at about 20 or 22% right now. I don't see that getting meaningfully higher right now. And we've been in the camp for a little while that May is a much more likely start of the cut cycle.
Okay, so we haven't completely closed the door, but there's a very thin crack of light getting through at this point. When the commentary picks up from non-Powell speakers, Collin, do you expect them to be a little bit more commanding with their language then?
I think they will. We've kind of seen that trend over the past few months and quarters. I mean, each official has their own opinion, but we have noticed a little bit of a shift from a number of committee members, voting and non-voting, about what their tone is, and it has been more dovish. So it'll be interesting to see, especially next week when we hear from some officials, how they react to the strong data we've seen over the past 2 days, knowing that came after the decision we got on Wednesday.
All right. Great stuff, guys. Excellent way to end the week. Thank you very much. Joe Mazzola, Collin Martin, great teamwork there. Collin, Director and Fixed Income Strategist at the Schwab Center for Financial Research. Joe Mazzola, Director of Education.